Hey everybody, welcome back to Whiteboard Finance. My name is Marco and I'm here to help you master your money and build your wealth. In today's video, I wanted to go over Vanguard's market outlook with the annualized returns with their predictions for the next 10 years. So a lot of people are talking about a lost decade. Let's see what Vanguard has to say about that. So first and foremost, we're going to get into a lot of interesting stuff here with different numbers and different metrics, but I want to actually conclude how they came up with these numbers. So Vanguard Capital Markets Model, their VC is basically a financial simulation engine that powers their investment outlook. So it has three different factors. We have a global dynamic model that forecasts the drivers of long-term asset returns, such as yield curves, which we talk about all the time on this channel, and also equity market valuations. Equity market valuations is just a fancy way of saying what we think stocks are going to do. So attribution models that attribute asset returns to the drivers, and then also a simulation engine to model the probability of distribution of outcomes. So let's take a look at what these outcomes are. So feel free to pause the video at any time. I'm not going to go through each one of these individually, but basically this in a nutshell, we have three different columns. We have equities and the different types of equities, different types of stocks. We have their return projection over the next 10 years, and then we have their median volatility, so how volatile this number may or may not be. So if you just look at general U.S. equities, just meaning stocks in general, they're forecasting 3.7 to 5.7% return over the next 10 years. Me right now, I'm getting 5% in an M1 Finance savings account. Okay, so do you really want to take on that additional risk to potentially underperform a high yield savings account? And again, these are just projections, so I'm just sharing this with you. We're going to see higher categories such as global equities minus the U.S. This is actually coming in 6.4 to 8.4%. And then if you take a look at what's been popular over the past 13 years of zero interest rate policy, it's growth stocks. These are your tech stocks. These are the high flyers that have been essentially propping up the S&P 500 all year to date. You can see what their projection is, and when interest rates are super high as they are right now, these valuations or projections make a lot of sense to me. They're projecting 0.8% to 2.8%. So the highest they have right now are global equities outside of the U.S., which in my opinion, with all the geopolitical turmoil going on right now, I'm not exactly sure how they're going to make that happen. One of the biggest underperformers in my portfolio has been VXUS, which is Vanguard's international ETF. But you can see, you can pause the screen here and take a look at each individual line item. So if we look at fixed income, these are bonds. You can see here that these are on average, they look like they're going to yield a little bit more, but I'm not a fan of bonds. I buy U.S. Treasury bonds. And I also buy U.S. Treasury bills, but I may make a video on why the Fed is potentially insolvent and why they're going to borrow another $1.8 trillion in the next month or so here, but that's outside the scope of this video. So I'm not going to spend too much time on this slide. If you want to see all these numbers, pause the video right now. So as we move along, this is an important page. I know it's a lot of text. I know it's not very dynamic for video, but I think it's important. So Vanguard's proprietary economic tracking model suggests that the quarter's GDP growth could be roughly twice our original expectation of 1.5%. So this was obviously printed or released before the GDP release numbers, which came out last week. Those numbers are 4.9%. So the reason I'm showing you this is because they were accurate in their assumption here, which kind of gives credence to the rest of the bullet points. So again, they didn't know it was going to be 4.9%, and they said, hey, it's probably going to be roughly twice of 1.3. It actually ended up being roughly 3 times. So if you look at these bullet points, I'm just going to read the highlighted points. Feel free to pause the video. But what they're seeing is continued deceleration in the core PCE. So PCE is just personal consumption expenditures. However, that excludes volatile food and energy prices. So the core PCE, would increase the likelihood of the Fed reaching its 2% inflation target in 2024. This is a good thing. I know most consumers, especially the middle class, lower middle class, even upper middle class, everyone's getting crushed by things that they conveniently exclude, such as housing and food prices, right? If you've been out to eat or if you've been to a grocery store, you know that it's significantly higher than what CPI is saying. So if we're talking about wage growth, job growth, all this stuff, they're actually saying that Wage growth, the number of long-term unemployed, and the private companies' employment growth suggest the labor market continues to soften gradually. So I talked about in all my videos, the housing market video I did a couple weeks ago, all these videos, everything is dependent on people's employment. So people are talking about how, mortgage rates were super low. A lot of people locked in a 2.5% mortgage, 3% mortgage. That doesn't matter if you don't have income. So that's why this is all hinging on unemployment. And if we move on, you can see here, though, while we remain modestly hawkish, expecting 1 to 3 additional increases in the Fed's policy rate in the coming months and no rate cuts until mid-2024 at the earliest. So they're talking about the Fed funds rate, how it's at basically 5.25 to 5.5% right now. Interest rates dictate everything, you guys. I don't care what anyone tells you. Think of interest rates as a lever. When it costs a lot of money to borrow capital from your commercial bank for either let's call it a mortgage, a business loan, whatever you want to borrow money for, that's going to dictate the cost of capital, which is only going to make returns more difficult. And then finally, we have here, they are predicting a recession in the next 18 months. That's their baseline expectation, though now we peg the probability of a recession at about 70%, down from our previous view of more than 90. So that's some positive news. So let's move on here. So if we look at, they broke this up into regions, or excuse me, the different currencies. I'm only going to talk about the US dollar because that's primarily my audience. They did the Eurozone, they did the UK, but let's talk about US dollar returns. So again, going back to equities, it's going to be for 2023, which is the darkest green, anywhere from 4.1% to 6.1%. Again, you can get basically 6% right now in a T-bill, which is considered a risk-free asset. And then also you can get 5% in a high yield savings account, which is 100% liquid. Does it make sense to invest in stocks right now? If you look at the global equities, again, getting rid of United States in this equation, 6.5 to 8.5%. Aggregate bonds, 3.8 to 4.8. And if you look at global bonds outside of the U.S., 3.7 to 4.7. So you can see how this differs from 2021. See how 2021 was significantly lower? That was obviously COVID. 2022 is a little bit higher, and now it's starting to move back just a little bit in 2023, which everything that I've been following, this makes complete sense. So we can't expect 13 years of zero interest rate policy like we've had for the last 13 years where everyone looks like a genius, because overnight Fed funds rate was basically ZIRP, zero interest rate policy. It was like 0.5%. Obviously, everyone's going to look smart in that kind of an environment. You're seeing this in commercial real estate. A lot of these syndicators that are a bunch of cowboys putting together money, they're starting to get flushed out now that interest rates have been hiked almost a record number of times in such a short period. So if we go to this is their forecasting model, and you can see how it's changed. So we have May 2021 here, May 2022 here, and then May 2023 here. And you can see how they're gradually getting away from U.S. equities. So if you look at 2021, it was 22%, 2022 is 19%, 2023 was 18%. This is basically kind of like their ideal portfolio right now. It's very bond heavy, coming in at over half, 55% for May of 2023. And then you basically have U.S. and international equities making up, I believe, 45%, if my math is correct there. Just kidding. My math is always correct. No, I'm just kidding. But if you look at the projected portfolio statistics, they're basically, if this was your pie, again, my whole investment philosophy is thinking of your net worth as pies. This is just your investment portfolio between equities and bonds, stocks and bonds. They're projecting 5.8% annualized returns with 7.4% annualized volatility with a 0.31% annualized Sharpe ratio. Sharpe ratio is basically just how much risk you're taking on in your portfolio for the amount of return that you're getting in a nutshell. So what are your thoughts about this? I'm going to give my thoughts real quick. I do want to plug Whiteboard Finance University just because I'm ridiculously proud of it. We've been up and running for about 2 months now. We have over 120 members. This community is popping off. We have monthly guest experts. We have live streams with me every week. We have professors. We have everything. It's an unbelievable community. We have live chats. The main chat is popping off. I highly recommend you take a look at this and consider joining. For the amount of money it costs for the membership, it's a metric ton of value. It will pay for itself in the first month. I guarantee it. Think of it like a gym membership, but with professors, but related to finance, investing, entrepreneurship, increasing your income, and investing in stocks and real estate. We have 3 full-length courses. It's just a ridiculous ton of value. So let's get back to the topic at hand. A lot of people are talking about a lost decade, and when they say lost decade, that's basically little to underperforming returns, in my opinion. Just think of everything as an equation. So say for example, you have a credit card, it's 17%. Okay, then you have the stocks that are going to be considered, I don't know, let's call it Vanguard's model, 6%, 7% annualized, a little bit less. And then you have a high yield savings account yielding 4.5% to 5% right now at the time of this recording. Where is your capital best deployed given the amount of risk? So if you pay off that credit card, you are making a guaranteed rate of return by paying off that credit card, tax-free and risk-free. So if your credit card is 17% or whatever number I just used for the example, that's a guaranteed tax-free, risk-free return of 17%. If you want to invest in stocks and potentially make, let's use the S&P 500 fund. I think year to date right now is somewhere around like 8 or 9% for the S&P 500. That's the return that you have to expect. Or if you're basing it off Vanguard's, that's the return you're going to expect, the 6-7% that they just projected, if that. And then finally, if you have a risk-free, high-yield savings account that's insured up to $250,000 by the FDIC, some are more, some are $500,000, some are $1 million, just depends. Are you happy with that 4.5-5%? So again, as investors, we are compensated for the amount of risk that we take on. If I was investing in some high-flying unicorn tech startup, there's a 99% chance that my money is going to go to zero. But there's also a 1% chance that I may make, 1,000,000% returns, for example. So it all just depends, you guys. I want to hear your thoughts below. What are your thoughts on Vanguard's assessment? Again, it's just a projection. These things can change tomorrow, but they've been pretty conservative and pretty accurate for the most part. So thank you so much for watching. I hope you got value out of this video. Please share this video. I don't really know how to title my videos anymore. I don't know how to do thumbnails. I don't want to be the clickbait guy. I don't know. So I'm relying on you to share these videos because the algorithm is not going to. Thank you so much, everybody, and have a prosperous day. Oh, yeah. Oh, look at that interest. Oh, give me that sweet 5%. Oh, yeah. Wow.